Welcome back. Take a look at futures this morning, extending yesterday's big sell-off. This on the first trading day of the new month of May. Dow Industrials right now down 95. The Nasdaq is down 140 and the S&P lower by 24. Stocks ending the worst month of the year as investors turn to the Fed's rate decision this afternoon. For the month of April, the Dow Industrials are down 5%, the Nasdaq down 4.5%, and the S&P 500 lower by 4%. Capped on the last day yesterday with a 500-point sell-off on the Dow Industrials. Federal Reserve Chairman Powell will hold his press conference today at 2:30 p.m. Eastern. Going into it, I spoke with the Wall Street Journal's chief economics correspondent, Nick Timrose, here on this program yesterday on what he expects to hear from Powell today. Watch. So what are you expecting from Jay Powell today, given that we've seen 3 straight months of inflation staying elevated and worries that, in fact, rate cuts may be off the table?
They'll simply take out the interest rate cuts expected this year or early next year. What that'll do is it'll raise interest rates across the Treasury curve. That'll tighten financial conditions. It's really the same effect that you would get from an interest rate increase. So I don't see a lot of appetite right now from most Fed officials to raise interest rates. I think what it would take, Maria, to put actual interest rate increases back on the table.
Joining us right now is Amerivet Securities head of U.S. rates, Gregory Faranello. Gregory, great to see you. Thank you for being here. And, of course, after that interview yesterday, we saw the employment cost index spike up 1.2%. Is inflation reaccelerating?
The Fed is in a tough spot here, in my view. I think Chair Powell is in a tough spot. Inflation is, I'm not sure it's reaccelerating, but it's certainly sticky, right? And look, if you go back in time, you look at history, you look at the peak in terms of what inflation did in 2022, you look at where we've come from there, it does make sense here that we kick these levels around a little bit. So we watch PCE inflation, which I think is what the Fed is going to watch. You know, right now we're 2.5% to 3%. I think if we stay in that range, markets ultimately will be okay. If we start to reaccelerate through 3 and head toward 4%, I think that's when things could get a little tricky. Adam, and we're not there yet.
Yeah, I mean, Adam, I would argue inflation is in fact reaccelerating. You had 3 straight months of inflation elevated, January, February, March, and then you had the first quarter employment cost index up 1.2%. Your reaction?
I know, and I'm a growth investor, so I really bear the brunt of that because, you know, growth stocks are more sensitive to interest rates. I think Greg raises a very valid point, and that is that the PCE, personal consumption expenditures, kind of geeky. That's what the Fed looks at. That's 2.7%. In fact, there are 4 different measures of inflation. CPI and GDP prices above 3, PCEs at 2.7, and PPI is down at 1.9. Average the 4 together, Maria, that's 2.8. Not all that bad if the target's 2. So, you know, I think we get fixated on these individual numbers, but when you look at the big picture, I don't think it's as bad as necessarily a down 5% month in the market would have us believe.
Well, things are definitely slowing. We've gone from 4.9% economic growth in the third quarter of last year to 1.6% growth in the first quarter of this year. We are getting jobs data this week, Mike. ADP number coming out this morning at 8:15 a.m. Eastern. That's will be followed by the March JOLTS report later on in the morning, and of course ahead of the Friday, April jobs number. Now, for the jobs number in April, economists are expecting 243,000 jobs added to the economy for the month of April. The unemployment rate holding steady at 3.8%. Gregory, I want to get your expectation on jobs, but weigh in here first, Mike.
Yeah, look, it seems like the economy is not doing great, but it's not falling apart. And the tightening the Fed has done, like, inflation's come down from, like, what do we hit, over 8% down to this 3% number, and we were all like, all of the experts had all these different opinions as inflation reemerged. It seemed like that the initial reaction that the last 1% from 3 to 2 is going to be the toughest hurdle, and that's where we are right now. I have a hard time seeing the unemployment spike or us having really, really ugly jobs data, even though I think the headline numbers are very misleading.
No, jobs have been holding up, right, Gregory?
They have. And, you know, Mike and I were talking before the segment today. Look, we're running deficits in the range of $1.5 to $2 trillion with an unemployment rate at 3.8%. So the Fed, you know, the chairman's job right now is really, really tough. And it's really, really tough because of the fiscal response that we have here. You know, look, some people will disagree with me on that, but I see it pretty clearly. If you're going to run deficits in the range of $1.5 to $2 trillion, it's hard for this economy to go down.
Well, you're talking about the tsunami of spending coming at the Fed. I mean, the Fed has been trying to rein in inflation, but is also facing all of this money flowing in the economy from all of the spending, $7 trillion on Joe Biden's watch.
Classic election year, right? You know,
exactly.
I mean, it used to be that the Republican Party was the party of restraint, and the Dems wanted to go spend the money. And then during COVID, Republicans realized, oh, if we throw a lot of money at people, they like it. So unfortunately,
there's no fiscal watchdog anymore.
Well, there's
period,
and
right?
you say they like it. They like it until they get to the grocery store and they see, you know, a steak up 40% from year over year, right? I mean, so anyway, bottom line, what do you want to do with your money at this point in terms of fixed income?
Look, I still think the short end of the U.S. curve looks very attractive here. I mean, yields have backed up. Our clients in general, Maria, very good investment opportunity. We talk to issuers and investors. Issuers are coming to the market. The market is wide open. Investors are very happy with these yield levels. So credit looks a little tight here. Treasuries, I think if we move another 50 basis points from here, I think the long end of the curve will start to look attractive, but not right here.
Yeah, the 10-year at 4.69% at this point. Greg, it's great to see you.
Good to see you.
Thanks so much. Gregory Faranello joining us.